Hi everybody, it's Peter Schiff. This is Thursday, May 20th, 2010. Well, it was a big day in the markets today, at least a big day down. The Dow was down, I think about 375 points. I think this is a closing low for the year. You know, it's interesting that if you look at the value of the Dow, even though the Dow is about 50% higher today than it was in March of last year at the absolute low, in terms of gold, we're only about 6% off that low. The Dow was at about 8 ounces of gold back in March of last year, and now it's about 8.5 ounces. So that shows you what's really happening to the value of U.S. securities and to the value of the U.S. dollar. You know, also it's interesting that gold was down today. It was down about $8. The gold had been strengthening when stocks were falling, but today gold was actually down. And the reason was that the euro had a very strong day today. And so it's very interesting that gold is really keying more off the euro than it is the dollar. And I think that's an interesting development because what it really shows is that the euro had been regarded as a store of value, as a safe haven, and people worried about problems in the dollar were seeking out refuge in the euro. But now that they're worried about problems in the euro, they're seeking out refuge in gold. And it shows that the euro, for many people, had already replaced the dollar as kind of the de facto reserve currency. Even if it hadn't officially replaced it in central banks. But now that people are beginning to view the euro with a lot more skepticism, the same way that they rightfully view the dollar, more people have been moving towards gold. And you know, when you hear a lot of the pundits on the financial channels talking about the weakness in the U.S. stock market, they're trying to attribute it to the problems in Europe and how it might spill over to the United States. They fail to recognize the fact that we've got our own problems that in many respects are more serious than the problems in Europe. And that's why our market is falling. It's not because of a spillover from Greece. We have got our own problems. I mean, look at the economic data that's coming out now. You know, we had a big jump in unemployment claims today. That was unexpected. The data recently on residential and commercial real estate has been very weak. The leading indicators were weak. And I've said many times on this video blog, there is no U.S. recovery. We haven't recovered from anything. Remember, the disease that we suffer from is excess debt. Too much borrowing, too much spending, not enough production, not enough savings. Well, we haven't cured that disease. The government stimulus, the bailouts have made it worse. We're deeper in debt now than we were before. And the problem is that much of this new debt went to expand the government, which makes our economy less productive and less efficient and less able to repay the debt, not only the new debt that we've accumulated, but the old debt that we already had. And, you know, today the Senate moved us one step closer to this new financial regulation, and it seems like it's going to pass pretty quickly. And, of course, as I've said before, none of this addresses the root cause of the financial crisis. In fact, it actually exacerbates those causes. Instead of taking away power from the Fed, we give them more power. And of course, we do nothing about Fannie and Freddie. We do nothing about the FHA. In fact, they are guaranteeing even more mortgages now than they were in the past. In addition, we do nothing about the FDA, not the FDA, the FDIC, and the moral hazards regarding the insured bank accounts. All this bill is going to do is make our leaders feel better or be able to pretend that they've solved the problem when all they've done is create an even bigger problem. You know, also along the lines of financial regulation, I saw Barney Frank interviewed on CNBC today. And when the subject of Fannie and Freddie came up, because I think one of the interviewers questioned him and said, you know, why aren't you regulating Fannie and Freddie in this bill? And his response was, well, we've solved that problem. They've gone into receivership. The government has taken them over, and so they're no longer a problem. They're no longer doing all the bad things that they were doing before the government took them over. Well, of course, that's completely wrong. They're doing everything that they used to do, only now it's worse because Fannie and Freddie are guaranteeing even more mortgages than they were before. In addition, he said that Freddie and Fannie weren't costing us anything. Of course they are. Didn't he notice that last $10 billion additional bailout money that they requested? They're still bleeding the Treasury dry, and it's only going to get worse because Freddie and Fannie now guarantee even more mortgages than they did before. The taxpayer is now on the hook for even greater losses. than they were before. It shows you how clueless the guy that's writing the financial regulation really is about the financial entities that they presumably are regulating. And you know, I had an interesting conversation today, again, to show you what's going on with government regulation. You know, I deal in my brokerage firm, Euro Pacific Capital, with a lot of foreign brokers, because we execute a lot of our foreign trades. And one of those brokers contacted me. I won't give the name, but the broker has approximately 200 American clients, American citizens. And they're working with this brokerage firm offshore. And this is not in the tax haven. This is not the Caribbean. You know, it's not. It's a regular developed country, not known for being a tax haven or bank secrecy, a first world major economy. And they told me that they have these 200 clients and that they cannot use them anymore. They cannot service them anymore. And they wanted to know if they can refer those clients to me so that they can transfer their accounts to Euro Pacific Capital. And I'm certainly happy to take the business. They sound like good clients and clients that I would like to work with. But I was very curious as to why they had to do this. And it has to do with tougher regulations in the United States. And this is what's happened. In the past, it is illegal for foreign brokerage firms that are not registered or regulated by the FINRA or the SEC. It's illegal for them to advertise to solicit business from American citizens. Now, I think that's wrong, too. I think that's a violation of our rights, but nevertheless, those are the rules. However, there was an exemption. If you as an American citizen take it upon yourself to pick up a phone book or the internet and contact a brokerage firm in a foreign country and you solicit them, then they are allowed to accept your business and accept you as a customer. Based on the new rules, that is no longer allowed. So that if you contact a brokerage firm at another country, they are required now to refuse you as a customer. And so this brokerage firm, in order to comply with this stiffer regulation, is having to get rid of all their American customers. Now, that should really bother you, the limitations of rights of Americans to do business overseas. That means American citizens cannot on their own decide that they want to do business with a brokerage firm, let's say in Germany, and call up a German brokerage firm or a Hong Kong brokerage firm, you know, or an Australian brokerage firm or a Norwegian brokerage firm and open an account. We can't do that anymore. That is a violation of the United States law. That is diminishing our rights. But what's more important is, why would the government be doing this? Why would the government be trying to prevent or make it difficult for Americans to move their money offshore? Obviously, they're trying to close off the escape valves. It is one step in the direction of exchange controls. The government understands that their policies are going to destroy the value of the dollar, that Americans are going to want to move their assets offshore to protect themselves. The government knows with massive deficit spending that huge tax increases are on the horizon, and they know that Americans might try to avoid those higher taxes by moving their money offshore. And so what the government is trying to do is make it more difficult for Americans to escape excessive taxes or escape excessive inflation by cutting off the ability of American citizens to invest abroad. And this is a very dangerous development. When nations are taking away your freedoms, taking away your ability to move your assets offshore to locations that you believe are safer than the United States, that is a very, very dangerous sign that we are headed in the wrong direction very, very quickly. You know, what I would rather do is not try to build walls to keep people's money here. Let's figure out what's chasing the money out in the first place and stop that. You know, why don't we repeal all the rules and regulations that are making us less productive? Why don't we stop the bailouts and the stimulus so we don't have to create all the inflation, so we don't have to debase our money? That is the problem. And again, you know, as I started earlier, to think that the market is now falling because of problems in Europe, when we have far greater problems in the United States that we need to worry about. And of course, you know, the problems in Europe now is that people are thinking that they're going to print too many euros to bail out Greece and other countries. Well, that's already going to happen here. We're going to print even more dollars to bail out government programs like Freddie and Fannie, Social Security, Medicaid, the states, you name it. Anyway, that's it for today. So long, everyone.